Welcome back, investors. I know I'm all close up to the camera, but we are trying to get our equipment back up and functioning and running. We're here in Northern Virginia, like many of you know, and we had this big snowstorm. So we are, we lost our power for about 10 minutes or so. Right as I'm about ready to go live and click that button, we all of a sudden lose our power and it drops. So now I'm just trying to make sure we got all of our devices up and running. We got the chat opened up. And instead of you guys just sitting there waiting for a blank screen, I figured I'd hop on here while we're going through this and getting everything reconnected. But yeah, Happy New Year. Welcome to a fresh year of trading. Everybody starts back at zero. At least at the beginning of today, everybody started back at zero. We did a lot of work over the weekend, and boy, oh boy, do we have everything ready to go. After the show is over, we're going to send out a whole bunch of information to Patreon members. We're going to open up our Discord to the public and also privately for Patreon members as well. So we did a whole bunch of work over the weekend getting everything all lined up and ready to go so that we can have an awesome 2022. Now, with that said, I hope you guys did have a good, hold on, the camera's going to shake a little bit here. I just had to get it plugged in here, so we're good to go. Hold on, one more little plug in here. Sorry if I'm too close to the camera. I don't like being close to the camera. Oh, where's the, here we go. Okay. All right, there we go. I think that is it. Okay, boy, oh boy, live streaming, huh? It is so fun and challenging, and man, oh man. Let's see here. FYI, the screen is a bit low quality, so you may just need to over vocalize the material. Okay, gotcha. I do apologize if the sound is off and the video is off. Everything's not exactly where I like it lined up to be. Just because I was trying to get back online quickly, so I might have fumbled over a couple of items. But yeah, anyways, here we are, a brand new year to start out investing. Like I said a moment ago, we all get to start at zero for the year and see how we end up doing. And our goal is to beat the market. And the market did really, really good last year with the S&P up nearly 27%. As the leader there, it beat the Dow, it beat the NASDAQ, a really nice gain. And it's a gain that's not typical. 27%, that is not a typical gain year in and year out. Investors that want to beat the market, they may end up doing 27, 30% on a year and think that is a really good and strong year. Well, when the market is doing 27%, then that means you need to put in maybe 45, 50%, which is a really, really hard goal to achieve. So when you are setting any type of goals for the new year, keep them realistic. There's a phrase that I kind of like is in investing that investors, the best ones, are realists. And they buy from the pessimists and they sell to the optimists. So being a realist in the market is one of the best mindsets that you can have. And don't let the whole psychology of money and all of that ruin your day if you have a bad day. Just think, the next day you can make it up. You can do better. As long as we're always learning and always moving forward, then everything is great. Everything is really good. Okay, let's get into the market recap real quick. Again, the most important thing about this live stream, this is our 60th episode, and I want to make this go strong this year. I really want this to go strong this year. We're looking for writers for our newsroom. So if you have any suggestions on that, just leave it in the comment section, send me a message. But the most important thing about this live stream is answering your questions. So if you have a question, leave the ticker symbol and your question in the comments, and we'll go over it live during the show. The show is live every day around 5 p.m. Eastern. Every day the market is open. And we always do clips of the show because I know some people don't want to sit down and watch for 2 hours straight. So we do clips of the show and publish that on our YouTube channel throughout the week. So there's always something to watch. So thank you for joining me. I'm glad you are here. And let's kick it off to what the market did today. So I'm going to hop over to TradingView and got Ethereum pulled up there. We'll talk about that in just a moment. Let me go to the S&P 500. So SPX is the ticker symbol in TradingView that I use to look at the market. And you can see here, green, beautiful candle to start off the year. And if we bunch this up here and just recap really quick what 2021 was all about. It was a really good year in the market for this beautiful 27% gain right here on the S&P 500. It held that 50-day moving average as support all the way up. Only 3 times, maybe 4th, if I count back here in February, that it dipped below that 50-day moving average, but it bounced right back. It always rubber band back above that 50-day moving average. Will the 50-day moving average be just as important this year as it was in 2021? I believe the answer to that question is yes. The 50-day moving average is always an important part of any strategy. And remember, technical analysis, it's not the end-all be-all. Technical analysis is just one more piece of the puzzle when you are putting together an investment thesis. It might help you to open your way on where's a good window for entry point. You've worked out an investment thesis. You think a stock is great. One that I'm talk about later for me is PayPal. I know it got beat up at the end of last year, but I think it could do good in 2021. I'm going to share my investment thesis on them in just a moment. But that's a company. You could use technical analysis to help you find an entry point. The support lines, resistance lines, those lines work. They're not end all be all, like I said about TA in general, but they do help. I mean, just look at the S&P 500 last year on the screen with that 50-day moving average. That's the blue line going up and to the right. Now, on January of last year, if I get it back here to where it opened, we got to go right here, January 4th. We actually opened on a down day. We lost 1.4% on the first trading day of the year. Now, today, we obviously gained over 0.5%. Just a little bit, but we did gain over 0.5%, 0.6 to be exact. And that actually got us to a new all-time high. The Dow and the S&P both got to new all-time highs today. So I would say that Wall Street, it opened great today. Really good. Hold on, let me click one more button here. One more button. Okay. So let me go into the not the investment thesis. Let me go into my quick opening monologue, and then we'll dive into whatever you want to, or we can dive into the stocks that I've got lined up. Now, like I said earlier, off to a great start. Wall Street kicked off 2022 with a strong move. Both the S&P 500 and the Dow Jones both closed at record highs, rising more than 0.6%, while the NASDAQ and the Russell 2000, they were the stars of the show. They both jumped 1.2%. Now, investors may have in the back of their mind, remember Omicron. It's out there. It may be in the back of investors' minds, but I don't think that's what was leading today. I think optimism about the economic recovery was more on investors' minds than any pessimist or any negativity. That's what really led today. Now, we continue to monitor, obviously, the rapid spread of Omicron, but that seemed to be in the back of investors' minds. I think people are getting fed up with it, quite frankly, and they just want to live their lives. Now, on the corporate front, Tesla, boy, oh boy. If I did my Catalyst Watch video this week, which I didn't because we had a lot going on with setting things up, specifically for Patreon members, I would have said Tesla is going to rocket today because of their delivery numbers. Now, we're going to go in a deeper dive on Tesla in just a moment, but Tesla was up more than 13% today after the company announced yesterday that it delivered 308,600 vehicles in Q4. And that beat estimates of 263,026. Beat estimates. More on Tesla, though, in just a moment. Wells Fargo, that stock gained more than 5% today after Barclays upgraded the bank to overweight from equal weight. Also, Apple, boy oh boy. Apple rose more than 2% today and became the first U.S. company to reach a $3 trillion market cap. $3 trillion company. That is incredible. Now, Amazon and the small caps may have adhered to the January effect. The January effect. The view is that beaten down stocks outperform to begin the year with the conclusion or the end of tax loss selling pressure. Just a thought there. Maybe that is going to continue for January. It did kind of happen last year. Monetary policy tightening, rising inflation, and midterm elections will be a spotlight this year that will bring FUD into the market. So we need to mark those dates on the calendar because that will provide uncertainty in the market. And we all know the market does not like uncertainty. Now, the S&P 500, the consumer discretionary sector, which is the home to Tesla and Amazon, that sector advanced 2.8%. But it was outdone by the energy sector, which was the biggest winner in 2021, by 3.1% today amid higher oil prices. It's now up to 76.05 a barrel right now. It was up 1% on the day. Now, the financials, they were up 1.2%, and information technology up also 1.2%. Those sectors followed suit, with the former keying up a big jump in longer date Treasury yields. Now, the 10-year Treasury, it rose 12 basis points to 1.63%. Now, inflation going up. The 10-year Treasury yield going up. What is going on with Bitcoin? BTC USD. People care about Omicron just fine, but they can't fix a compromised government owned by the very capitalist we practice to be, so let's not do that. Well, no, this isn't a political channel. It's not. But I do talk about things that do affect the economy. And Omicron is a part of the equation. But I truly believe people just want to get back to life. That's what I mean when I say maybe I used the wrong word. But I think people just want to get back to life. That's what I meant when I said it. So not to get political and choose one side or the other, because I try to keep it right down the middle. But it is a thought of mine, a belief, I should say. So maybe that is crossing the line a bit on a financial channel, but that's all you'll hear from me about it. Okay, Bitcoin and Ethereum today, they were both down over 2% to start out 2022 and the investing year. Now, Bitcoin right now is at 46,190, 82.79, bouncing around. Now, if we look here at the area in this yellow box, yellow shaded box, I'm going to move it out a little bit further here. We've been watching this now for over a month, or just about a month, this yellow box. This is where Bitcoin is bouncing around in, okay? Now that it's at the beginning of the year, we need to come up with a new thesis for cryptocurrencies. I still believe in the long-term view of blockchain. It is a good technology, and it is a technology that will persist, that will carry on, keep moving, and keep innovating. And I'm sure at some point in the future, the Fed, those in charge of monetary policy, they will at some point create some sort of law or rule to restrict, to help protect investors in some way, shape, or form. And I know that is coming at some point. I would say that for anyone coming up with any sort of policy or rule or law on cryptocurrency, as long as it protects investors, number one, and number two, as long as it doesn't hamper innovation, then I believe it's a good thing for the crypto market. I do believe that a wild west of the market will continue, to many getting hurt and many getting rewarded, many making it. I mean, we ourselves as investors, we try every day to outdo the market. And if we look at Bitcoin, it did do, what was it for the year? 78, 79 to 60% on the year. So it did way outperform the S&P 500 at 27%. But Ethereum, which we'll look at here on the screen in just a moment, that was up nearly 400% on the year. Can we see those same types of returns again this year? I don't know about 400%, but I do believe on the Ethereum side of the coin, with Bitcoin and Ethereum being the top two, I think Ethereum's update in the first half of this year, maybe the first quarter of this year, will do a lot to help to appreciate the price of Ethereum. Bitcoin, on the other hand, this stall that we have seen over the past month, it is holding or trying to hold this line right here that I have at 46,500. To me, that's an important line for Bitcoin. Now, for retail investors, Bitcoin can be a tricky subject. There are many, if you go on Reddit and just read and read and read and read, there are many who did very well. They bought Bitcoin either at the end of 2020 or beginning of 2021 and held it all year. Did great. Can we have the same buy and hold mentality for Bitcoin and Ethereum this year? I believe yes. Yes, we can. Now, when I bought Bitcoin and Ethereum into 2020, beginning of 2021, I haven't sold yet. I do not plan on selling. Not anytime soon. I will continue to stack my crypto, my Bitcoin and Ethereum, and I have no end date for doing such. So I really don't have anything to add to the conversation for Bitcoin other than this line at 46,500. It's important to me that Bitcoin not go lower. If it stays in this yellow box and it doesn't go lower, in the bottom of this yellow box is at 45,400. That's where the lowest candle got over the past month here in this box. And I'm just double checking here to make sure. 45.5, that's 46. 45.5, 45.4, 45.7. Yep. So a bottom down here at 45, 400, 300. If it stays above that, that's positive in my view. All right, Bitcoin on the year is up 0.2%. So that's good. But it is down 10% over the past 3 months, looking at TradingView here. All right, let's look at Ethereum, ETHUSD. And then we'll get into the stocks oh, wrong one. And then we'll get into the stocks that I mentioned. ETHUSD. And then I use Coinbase, not Bitstamp. All right, Ethereum is in a downtrend. It's trying to hold a base way down here at 35.79. As a matter of fact, I'm going to put a line there. 35.79. And you can see that big low that it made on December the 4th, that was 35.75. So just a little bit below that line. And then again, it touched it here on December the 30th, 35.85, and then before it, 36.03. So it's trying to build support base around here, that 35.79. And like Bitcoin, if it can just move sideways and allow people to accumulate their Ethereum, their Bitcoin, then in my book, that's okay. Now, what's going to be important for Ethereum is the update, and it is supposedly happening in the first half of the year. As we get closer to maybe the middle to end of the first quarter, we'll dive into the update because I think it can affect Ethereum's pricing moving forward. But it is up 2% on the year, which is positive. If we put a trend line here, let's move this top one because this pattern no longer holds. So we're going to move this a little bit here, and we're going to adjust for what we have right now. Now, remember, when you are drawing your trend lines, you want to get as many points of contact as possible. You can have a minimum of 2, but having 3 or more, that's what makes the trend line stronger. The more points you can have, the better. So let's move this one down here. And really we have only 2 on the bottom. We've got this first one here when it got to that low, 35.75. So I want to bring it up as close to that as I can get right there. And then this low here is just slightly above it, 35.85. And now when I do that, 35.85, 85. That bottom line looks pretty straight. Slightly with an incline, but it looks really flat, really straight down there. Now your top line, this is definitely shaping up to be a descending triangle, which can lead to reversals for Ethereum. We've seen that before back here during this phase in September. We saw that descending triangle and then the nice rally breakout of it. Now, when we look at the long-term trend here of Ethereum, and I got to take my lines out a little further for 2022, you can see that Ethereum, it's just below a important trend line. And it's really got this big gap here between the two trend lines that it could potentially fall. And quite frankly, in my book, it's not scary. Red days aren't scary. Red days are your days to buy. So Ethereum right now, that trend line is at 34.19. So if Ethereum did break this support that it looks like it's trying to build right up here at this 35.79, if it does break that, then this trend line here would be the next area of support. And interestingly, that trend line is at its 200-day moving average, which is also very interesting. Its 200-day moving average right now is at 33.86. So I think that would be an area if Ethereum did break down. And again, this support that it has is not strong. It's very weak. There's only 2 points on that trend line. It could break down below that, and its 200-day moving average would be your next area of interest. All right, let's go and dig into Tesla. I'm really excited to talk about Tesla. TSLA on TradingView. And what a run today. And my goodness, it really comes down to Elon Musk and preparing for the future, preparing for shortages. He's really made a difference. Now, Tesla, it's receiving a strong jolt after impressive, and I mean impressive, Q4 delivery numbers. We talked about briefly at the very beginning. I think this shows Tesla's resiliency is on wide open display again for everyone to see after the company reported, can I say, electrifying Q4 delivery results that not only smashed analyst expectations, but also set a new company record. Now, underrated by ongoing supply chain obstacles. Total deliveries surged by 71% year over year to the 308,600 I mentioned at the beginning. Those vehicles being delivered, with the Model 3 and Model Y leading the way. On a combined basis, Tesla delivered nearly 297,000 of those two vehicles, up 83% from a year earlier. Now, from a broader perspective, it's clear that consumer demand for electric vehicles, EVs, continued to strengthen as 2021 came to a close, providing Tesla and its counterparts with a powerful tailwind. This upswing was also illustrated by impressive December delivery report from China-based EV makers NIO, ticker symbol NIO, and XPeng, ticker symbol XPEV, which registered year-over-year growth of 51% for NIO and 181% for XPeng. That's year-over-year growth, along with sizable governmental tax credits, major advances in battery technology. Oh, and on those tax credits, I guess I'm not supposed to talk about it. Elon Musk said, cancel them all. We don't need tax credits. He said, get rid of them. Just a point, something to note back in your mind, because you hear a lot of individuals talk about, oh, Tesla's only profitable because of tax credits. Well, Elon Musk said get rid of them. Doesn't need them. All right. Major advances in battery technology and more affordable price points have elevated EVs to what I would say mainstream. For Tesla, the Q4 delivery report puts a bullish bookend on a year that became a bit bumpy after CEO Elon Musk followed through on the results from his own Twitter poll by selling 10% of his Tesla holdings. Vehicle recall issues also emerged again late last week. Earlier in 2021, safety concerns from Tesla's autopilot system prompted the National Highway Traffic Safety Administration, mouthful, NHTSA, to conduct an investigation into the self-driving technology, leading to a high-profile recall. This time, the issue stems from faulty hoods and backup cameras, causing Tesla to recall 500,000 vehicles. However, negative headlines for Tesla never seem to have much staying power. And I believe some of those are overblown. Some of them. Although safety is paramount, we have to make sure that there are safe vehicles driving down the road. And Tesla has demonstrated time and time again of the safety of their vehicles. And again, my opinion, you may have a different view, and that's okay. But today's stunning Q4 delivery report, it shines the spotlight back on the company's remarkable execution and its momentum heading into 2022. While Tesla has not been completely immune to the chip shortages, the challenges that provides, the chip shortages has plagued the auto industry. But Tesla has evaded the complications much better than most. Now, a key to the company's success has been its ability to develop new firmware to integrate with chip makers by different suppliers. That was a strength of Tesla during the chip shortage. Being able to dig down and find other suppliers and then provide the software to make it all work. This type of flexibility and innovation will be paramount in 2022 as Tesla fires up new plants in Austin, Texas, and in Berlin, Germany. The addition of those facilities should help push annual production towards 1.5 million units. Maybe this year. They came oh so close in 2021 to 1 million units. How about 1.5 million units for 2022? But Musk has warned that supply chain shortages could persist until 2023, which is interesting. Now, I believe he's a genius, so I'll put a little extra weight on Elon saying this than I would on all the different manufacturers that I've looked through over the past 6 months. And the majority of them saying that supply chain issues should ease in 2022. Now, easing isn't going away, but it is doing better. So, through 2023, Elon believes supply chain shortages will continue. So, we should put this in our investment thesis for any company that relies on a supply chain. I think that's most of them. Although he still expects the company to achieve 50% average annual growth in vehicle deliveries over a multi-year horizon. The complexity of launching new plants and new vehicle models in this environment is substantial. On a related note, Tesla's CFO warned during the Q3 earnings conference call in October that automotive gross margins will likely slide lower once the two factories are operational. After expanding by over 280 basis points last quarter to 30.5, not 35, 30.5%, this metric exemplifies Tesla's progress in manufacturing efficiency. Since some margin erosion is anticipated and understood, I believe the primary narrative for Tesla in 2022 will be production and delivery growth. That should be good news for Tesla investors because the company has routinely outperformed expectations on these measures. All right. Of course, Elon Musk, no more tax credit after taking $5 billion of our taxes, and he's still selling luxury vehicles 10 years later. Okay. No worries. We can have our own opinions for sure. All right. So Tesla right now with this 13.5% jump today, I believe that this is a big jump, and I believe this big jump will have to fill in the gap. So if you don't own Tesla, this is not the time to start a position. Now, if we look, Tesla's getting back to that new all-time high of $1,243. It's at $1,204, rounded up to $5. So $1,205 in the after hours. It's up another 0.4%, back into $1,200 territory. Getting close to all-time highs typically is not the best time to open a position. Because a lot of times, just look what happened back here on November the 4th. After reaching that high, it fell. And there was a 12% down day on November the 9th. Then we have this falling wedge pattern and a beautiful technical breakout of it. Now, it was finally starting to settle here on its 50-day moving average. I say finally, 2 days worth of settling on it. That 50-day moving average right now is at $1,066. That's where Tesla could come back down to. So this high flying now, it's a potential that it could continue tomorrow. But at some point over the next day or few days, it should come back down. But another note, remember all of last week's videos, we talked about low volume and how that's historically typical of trading during the last few sessions of the year. And you can see that represented down here with the red and green bars along the bottom. You look at today's volume, it popped to 34.7 million. We closed out the year on volume of 13.5 million. So a big jump. Average volume right now is 23.3 million. So even blew past that today. But this was a big mover due to news, due to the delivery numbers. So the fundamentals for Tesla changed just so slightly, ever so slightly, because of these big delivery numbers, nearly hitting 1 million vehicles last year. So the playbook going forward for this year, if you haven't started Tesla yet, you definitely need to find your entry point, because this is a company that I believe is going to revolutionize so many different aspects of our lives, from electric vehicles. Look at the robotics the company has. If you took the robotics out of Tesla, that could be a company all on its own that not a lot of people talk about. Tesla is not just an EV maker. They don't make just electric vehicles. They also build robotics. And that's a part of my investment thesis for Tesla. In the robotics segment, that could help in so many different industries. And if we want to talk or just touch on one small aspect of that robotics portion of their company, if you look at other robotics companies around the world, there are a lot of good ones. But how many robotics companies around the world are also good at manufacturing? Not too many. And if you look at other manufacturing companies around the world, how many of those manufacturing companies are good at robotics? Not very many. So when you take that one aspect of Tesla, the robotics segment, that they have been working on for over a decade, the manufacturing that Tesla has, and you put those two together, then you have the potential for Tesla being a massive robotics company. It is all possible. And if you take robotics and then add that to their market cap, then Tesla can go a lot higher. All right. Elon isn't a genius. He got started on mine money and ended up owing the U.S. taxpayers and, okay, of his success and those factual $5 billion, not an opinion. Didn't realize you were in, no. I'll push back on that a little bit. I don't think that you can accomplish the manufacturing feats, the engineering feats, without being very smart. And that's what Elon has done. So if your view is he's not a genius, that's okay. There's nothing wrong with that. And if your view is negative, that's okay. Or I shouldn't say negative. That's the wrong choice of word. Because one opinions can be their belief, and it can be neither positive nor negative. It's just a belief. And we all have our own investment thesis. Not a single person has an identical investment thesis to another, because we all have our own thoughts, our own processes, our own ways at arriving to a conclusion that we need to get to an investment thesis. So it's okay. Different ideas are fine. But winning at investing, there are thousands of stocks and different companies to choose from. And you don't have to like the ones that I invest in. You can invest in the ones that are more fitting to your style, and that's fine. All right, moving off of Tesla, I just want to bring up that robotics portion because I think it's an interesting angle that I don't hear many talk about. All right, I want to talk about PayPal. And yeah, if you want to say it's kind of linked to Elon, but I didn't plan it to be linked to Elon. But PayPal, PYPL. Now, this company got hurt at the end of last year. And we talked about it a lot during the decline of PayPal at the end of last year. I think we were talking about PayPal every day for at least a week, maybe 2 weeks when it was falling. And I know a lot of us, and a lot in the comments too, were really talking about that $200 mark as a strong area of support. And if we go back here and look, October of 2020, September of 2020, August of 2020, and July of 2020, the $200 moving average played a big role in PayPal's ascend. So here we are again today talking about PayPal, and it was nice today. The market and everyone moved. It was up 3.3%, flat in after hours, but it's getting to this resistance area that over the past month it's had a hard time to break through. And that's right here at $195. It's gone up to this line several times, but has not been able to break above it. Now, even though we did have higher volumes today, we had 12.7 million today for PayPal, and the average is at 11.4 million. Volume has really been declining, and relative strength has remained relatively flat. It's at a 51 right now, and it's been hanging at 51, 50, 49, 48 over the past week. And it's really trying to build this base at $185. So that's a window that I feel comfortable investing in for PayPal. So let's dig into PayPal just a little bit. And part of the reason for its 3.3% move today was because PayPal found a pal with BMO Capital. That firm, BMO Capital, it upgraded PayPal today to outperform with a price target of $224, or about 15% or so above its current level. Now, BMO Capital noted that payment processing, PayPal, roughly fell about 20% during 2021. And they believe that that 20% fall went too far. Now, they talk about PayPal, and they said that PayPal is set up constructively for 2022. And over the past 3 quarters, PayPal endured a series of revenue misses and downside quarterly guidance, raising concerns over whether the company's issues stem beyond the unwinding of its eBay business. And eBay's ticker symbol is its company name, EBAY. Now, a pandemic darling, I should say, PayPal had seen its shares more than double during 2020, making the revenue misses in 21 all the more shocking to investors. PayPal was not alone in facing a challenging 2021. Other payment processors such as Block, these name changes. Square's or Block's ticker symbol is still SQ. And Global Payments, ticker symbol GPN, saw even more pronounced declines in the year. A major culprit was a significant drop-off in online spending, especially as foot traffic began to recover to pre-pandemic levels. For example, PayPal's total payment volume, TPV, grew just 8.7% to $310 billion from Q1 to Q3, with only 0.3% quarter-over-quarter growth into Q3. However, in 2021, now in the rearview mirror, PayPal can set its sights on what looks to be a much friendlier year. One reason for this is that PayPal users can pay using Venmo on Amazon, ticker symbol AMZN, starting this year in 22. Venmo is already proving to be PayPal's fastest growing product, recording a 36% jump year over year in TPVs in Q3, with $900 million expected in sales in fiscal year for the entire year of 21. Even though $900 million represents just 3.5% of total estimated fiscal year 21 sales. The Amazon deal should lead to a significant boost in revenues TPVs in fiscal year 22. Also, PayPal announced in Q3 that Walmart now presents PayPal as a checkout option for its grocery and marketplace business, adding more fuel to Venmo's growth. Along with Venmo's potentially massive growth in fiscal year 22, PayPal's Buy Now Pay Later, BNPL, that service, which launched in August of 2020, getting my numbers mixed up. August of 2020 has very quickly grew to over $5.4 billion in TPV. Over a third of that came in Q3 alone. Now that PayPal has closed on its $2.7 billion purchase of the Japan-based Buy Now Pay Later platform, Paidy, 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 I believe it is. I believe 2022 will see meaningful growth in PayPal's Buy Now Pay Later service. Bottom line for PayPal, 2021 presented its share of hurdles for PayPal and Square too. It wasn't off the hook. But in fiscal year 22, the company will no longer face the difficulty of lapping unfavorable numbers, meaning the growth from 2020 won't be affecting PayPal's numbers in 2022. Also, retail spending, it remains high, as evidenced by earlier holiday season shopping reports. So, investors will be expecting solid fiscal year 22 guidance when PayPal reports its earnings. It looks to be in about 30 days from now, around February 4th. So we'll be watching February 4th very closely as PayPal reports their earnings right here. And right now, we have an estimated EPS of $1.12 on revenue of $6.9 billion. Now, these numbers are important, but when PayPal reports, it's their guidance for the rest of the year that matters the most. That matters the most. So that's what we need to watch when PayPal reports. Now, until then, I could see it staying within this range that it's in. 185 support, 195 as resistance. Maybe if we have a really positive start to the year in the market, maybe it could get up to that 50-day moving average, which right now sits at $213. But I think that would be real resistance, especially leading into earnings, because investors are going to be shaky on PayPal until earnings and we get that guidance. Okay, let's continue on. There is another company that I did want to talk about. We don't have to take too much time into it. It's one that got really, really beat up in 2021, and that's Splunk. Now, as we go down and talk about Splunk, they are going through a transition as a company. And there's other companies we've talked about before that are doing this exact same transition, completely changing the business model, the structure of the company, the way the company operates, going more digital and in the cloud. And for most companies who have gone through this process, it's worked out for them. Now, some of that could be a luck factor. Doing it, planning for it 5 years ago, executing on it 2 years ago, right as everyone was trying to go digital. So maybe the timing is good for this restructuring, for this move to focus more on digital and in the cloud. All right. So let's get into that. So we've got, oh, there's that silly timer going off in the background again. All right, so we've got Splunk, ticker symbol SPLK. And you can see horrible end to the oh, such a bad end for the year for this. But that's what makes it really interesting, though, to me, is those companies that just got beat down over and over and over again and just couldn't find the footing. Those companies, to me, are interesting, because if we look here at a much bigger view of Splunk's history, we can see that they've had some pretty tall mountains. And they've also been working up, and they're in this, getting close to this range area here. I've got this range for them at $122 to $137. So they're not in that range quite yet, but they are getting close. So let's talk about Splunk as, I want to say, an investment idea for 2022. It's a cloud-based turnaround I think, ready to unfold. So with its stock down nearly 33% in 2021, big data company Splunk, and their ticker symbol again is SPLK, was ready to turn the page on a turbulent year that saw its CEO unexpectedly resign amid a string of disappointing quarterly results. I mean, if we look at the history here, quarterly, we have 2 beats on the past 2, a miss, a beat, a miss, a miss, a beat, a miss. So they have a 50-50 chance of missing it or making it on earnings. Just want to open this chart up to today. All right. So today, even for Splunk, when volume was back all across the market, Splunk had 1.8 million trades, but their average right now is 2.2 million. So their volume didn't even make it up to par with the market. Relative strength right now is at a 50. So that's not oversold. It's not overbought. It's kind of right there in the middle. Now, the former, and we looked at this when we scrunched up the chart here, the former high flyer, which routinely generated about 30 to 40% top line growth, stumbled greatly in the wake of the pandemic as some of its larger customers hit the pause button on spending. Against this backdrop, Splunk also began to execute a major transition, moving its offerings to the cloud while modernizing its pricing model. This shift created additional challenges from an execution and sales standpoint, like standing tall, causing Splunk to post 3 straight revenue declines in Q2 21 through Q4 21. Now, signs are starting to emerge that the worst of the company's troubles may be in the rear view mirror, setting the stage for a potential comeback in 2022. Now, most encouraging is the upswing in cloud annual recurring revenue. And you guys know, I love a company with recurring revenue. It might be a bit of a bias of mine when looking at companies because I love that ARR. Now, it's illustrating that Splunk's transformation is taking hold. In Q3 of 22, their fiscal year, cloud ARR, it jumped. Sorry, I have to look at my notes there for a second. 75% year over year to $1.1 billion and accounted for a record 68% of total software bookings for the quarter. In a reversal from last year, the strong growth was bolstered by an acceleration in large contract wins, helping to ease a source of frustration for investors. As a developer of data collection and analytics tools, Splunk would seemingly benefit from the digital transformation that it has another gear over the past 2 years. With a new pricing policy in place, that only charges customers based on the volume of data processed, sounds like Snowflake. That's a similar pricing structure. It appears that this massive secular trend is finally providing Splunk with a boost. Looking ahead, this cloud-based momentum is expected to continue, for fiscal year 23 for Splunk. The company is forecasting cloud ARR of at least $2 billion, representing estimated year-over-year growth of 50%, based on Splunk's outlook for fiscal year 22. The brightening growth outlook is only part of the equation, though. Due to the stock's dive lower, Splunk is now trading with a compelling forward PE of about 6 times. Where do you see that in technology spaces? Sure, Intel is maybe a 13, but that's more manufacturing. This is more software. 6 times forward PE, or PS, sorry, to sales. While I do acknowledge that a premium valuation isn't warranted at this time, I do believe that the lower PS metric has created an attractive risk reward. As investors, whenever we put together our investment thesis on a company, we always have to evaluate the risk reward equation. Does this fit with our investment thought? There are still bound to be a few bumps in the road for Splunk as it continues to turn things around. So some patience will be required. On that note, the company expects fiscal year 22 non-GAAP operating margin to slide to 17% to 15% as it builds out its infrastructure to support its cloud hosting capabilities. My goodness. For some perspective, though, Splunk's non-GAAP operating margin was just 4% in fiscal year 21. Excuse me. Wet the whistle there for a moment. Just 4%. Sorry about that. And that was at the end of January 31st. So just about a year ago, it was at 4%. Additionally, the company is still in search of a new CEO as chairman of the board. Graham Smith will continue as the interim CEO until they can find another one. They have to find another one. It will happen at some point. And that announcement of a new full-time CEO may serve as a catalyst for the stock, as a key overhang is removed. And that could turn into a tailwind. Playbook. Splunk's fundamentals are far from perfect right now, but the arrow is pointing in the right direction. The company's transition to a cloud-based model better positions it to capitalize on the ongoing digital transformation trend. With its 2021 struggles already priced into the stock, I believe that a rebound can unfold for Splunk in 2022, especially once its leadership is fully in place. Okay, that's my thoughts on Splunk. And if we go back and look at this run that they were on, when we thought things had turned around for them here on June the 3rd, 2021, and they went on this rally, I think this structure right here is something that we could see most likely after we get past this earnings wall. Because like PayPal, We want to hear about the future of Splunk. We want to hear that they have a new CEO incoming with experience on cloud-based products. That would be really good. But even though that may not happen, I do believe it will take until its earnings, which are scheduled for March 3rd right now. That's a long time to be patient and wait. Maybe we can get an announcement before then about the CEO role being filled. But I think that's one of the main catalysts holding Splunk back right now. Once that new CEO is in place, then I think Splunk is off to creating its own path. All right, let's move on from Splunk and go to another direction. I want to talk about Bath & Body Works. Now, there are companies that are more female-centric, and females invest in those type of companies. So I don't want to leave those companies out. I want to talk about them too. Bath & Body Works. The ticker symbol is BBWI. Excuse me again. BBWI. Look at 2021. Excuse me. I don't know why I'm getting so choked up here. It nearly matches the move of the S&P 500. Nearly. Not perfectly one-to-one, but it does kind of match up. So for Bath & Body Works, I also want to talk about them as a 2022 investment idea. What I really like is its dominant position and its robust margins. So in celebrating the new year upon us, as you can see, I've been talking about PayPal and Splunk, companies that could do really well in 2022. Most importantly, beat the market. A lot of the picks from 21 performed very well. Now, today, I want to try to put you in a Zen state of mind and talk about Bath & Body Works. Formerly known as L Brands, Bath & Body Works is one of the world's largest specialty retailers of fragrances of the body and home. Products include the #1 selling collections for fine fragrance, mist, body lotion, and body cream, 3-wick candles, home fragrance diffusers, and liquid hand soap. It currently operates 1,750 plus stores in the US and Canada and has more than 300 international franchise locations, as well as a really robust online sales. Here's why I like it for 2022. Bath & Body Works has been a huge beneficiary of the pandemic with its soaps and sanitizing flying off the shelves. While those type of sales may slow down a little bit in 2022, the pandemic introduced the brand to scores of new customers who will likely return. The company is now a pure play after it spun off its struggling Victoria's Secret. Ticker symbol VSCO. We've talked about them before on the channel. Now, they spun off Victoria's Secret in July of 2021. I think Bath & Body Works was more of a crown jewel of L Brands and will be better off on its own without Victoria's Secret weighing on its results. Now they can stand on their own 2 feet. Both Bath & Body Works, and Victoria's Secrets. Bath & Body Works reported a huge EPS beat for Q3 back in October. This was its first quarter following the separation, and I like what I saw. Sales were down slightly year over year, but Bath & Body Works was lapping a huge quarter during the pandemic when soap and sanitizers, when those sales were booming. Compared to 2019, the October quarter, those sales were up a robust 53%, and adjusted EPS jumped 360%, which I think is great evidence that pandemic customers are sticking around. I'm a pretty big fan of Bath & Body Works' robust margin too. Year-to-date adjusted operating margin stands at 23.3%, down a tiny bit year over year following the pandemic sales that surged last year, but they are holding up nicely as Bath & Body Works has been reducing promotions. Sound similar? Because Victoria's Secret is doing the same thing. They're reducing and getting rid of promotions to help elevate the brand. So now both of them are doing this. I find that interesting. There was obviously a plan at the beginning when separating out these two companies that there would be some link still in the middle, and there is. Also, the company says it's better positioned than most retailers due to its primarily domestic supply chain. I think that's a really good thing. So it's not seeing surging online freight costs like many others. Bath & Body Works is not an entirely clean story, as it has been experiencing inflationary pressures in raw materials, wages, supply chain, and transportation costs. And also, management expects even more pressure on Q4, which comes out in January. Now, those results for Q4. Now, Bath & Body Works says it's proactively managing pricing and promotions with the goal of offsetting much of this cost pressure as possible. Playbook? You really got to appreciate Bath & Body Works' standalone metrics once Victoria's Secrets is off the books, especially margins. And I like that. I like what I'm seeing here. Fragrances clearly are a highly profitable business, and these new pandemic created customers definitely seem to be sticking around. I view Bath & Body Works as similar to Ulta Beauty, ticker symbol Ulta, ULTA, in that they both have dominant positions in their industries. I also think Bath & Body Works is trading at a reasonable valuation with a forward PE of 14.9 times. Bath & Body Works has been trading on its own for just 6 months now, so it may not have gotten much attention. However, I think as investors give the standalone business a fresh look, they'll see exactly what I see. What do you think about Bath & Body Works? Is that one for you? All right. Well, those are the stocks that I wanted to cover today. We've been going now for about an hour and 20 minutes, and we started late, so it's getting late for everybody. I'll roll through. I don't think there's a comment that I missed. I apologize if I did miss a comment. I do see a couple of spams in the comment there. Don't click on those links. I'll get those out of there as quickly as I can. I don't think I can. Yeah, I can't get rid of them right this second. So I'll go back and try to get rid of those. Don't want those in there. All right, so if you found this video to be helpful, informative, actionable, then click the like button. That tells YouTube that you think this video is good. Next, grab the URL and share this video everywhere, anywhere you can. That tells others you think this video is worth a watch. That really helps us meet our goal of financial freedom for all. And if you liked my perspective, then click the first link in the description below for trade ideas, stock ideas, and other exclusive content, including what's coming out in just a few minutes, my top 10 growth stocks, my top 10 value stocks, my top 10 dividend stocks. And the dividend stocks are based on a new idea on how to rank dividend stocks. And I'm going to include that reasoning behind it. It's not about who pays the biggest dividend. Now, all of those are updated once a month. And then you have my top 10 momentum plays, which is updated every week. Those are about to be sent out as soon as this live stream is done to all Patreon members. So you can get a glimpse and see. And maybe when we do our updated list for February, maybe I'll share our January list. Maybe I'll do a poll and let Patreon members vote on that or not, if that would be okay. But it's a great way to help support our research, analysis, and technical breakdowns. So make sure to click that first link in the description to become a Patreon member today. There's a tier for everyone. And make sure you're subscribed to get my Catalyst Watch video. It comes out every Sunday evening. I know I skipped this Sunday. We had a lot going on behind the scenes. But starting this coming Sunday, which would be the 9th, January the 9th, we start our new year of Catalyst Watch videos. And they're the most important video that I do all week long. They give you a heads up on stocks that are about to move. For example, if I did have the Catalyst Watch video yesterday, I would have definitely talked about Tesla and that it was going to move today, which it did because of their awesome delivery numbers. Now, remember, if it's a good story, has a good chart setup, then it's a good investment. So that'll wrap it up for today's show. I want to thank everybody for being here for our first show of the new year. I am so glad the power stayed on for the show because we did lose it at the very beginning, and that's why we were late. So thank you all so very much for watching, and I'll see you in the next video.